Did you know that 70% of Americans are living paycheck to paycheck? Despite working hard, many find it nearly impossible to save or invest. The truth is, relying on a salary for financial security is like building a house on sand. One small wave, like a job loss or an emergency expense, and everything can come crashing down. Here's another shocking fact: the average millionaire has 7 income streams. That's right, most wealthy people don't just rely on one job to make ends meet. They invest, create businesses, and develop passive income sources. If you're only depending on your salary, you're missing out on real wealth building opportunities. In this video, we'll explore why a steady paycheck won't make you rich and what you can do to change that. You'll learn about the salary trap, the secrets of successful investors, and how compounding can turn your small savings into big money. We'll also discuss the importance of a shift in mindset, from being a consumer to becoming an investor. Ready to break free from the paycheck cycle and start building real wealth? Let's dive in. Chapter 1. The Salary Trap. Why your 9-to-5 is a wealth mirage. Most people assume that working hard at a stable job is the ticket to wealth. But the reality? Relying on a salary alone can be a financial dead end. According to the U.S. Bureau of Labor Statistics, the average salary increase is just 3% per year. That's barely keeping up with inflation, which averaged about 3.8% over the last 50 years. So, even if you're doing well at work, that raise might not even cover your rising expenses. The salary trap is the cycle of working for years, trading hours for dollars, without gaining true financial freedom. In fact, 71% of Americans say they live paycheck to paycheck, according to a survey by Lending Club in 2023. When your income depends on your hours, you're limited. Not only do you cap your wealth potential, but you're also at risk if anything happens to that job. Warren Buffett once said, "If you don't find a way to make money while you sleep, you will work until you die." He wasn't just talking to billionaires. Even modest investors can benefit from this mindset shift. Building wealth is about creating a stream of income that doesn't depend on your daily grind. Think of your salary as a tool for investing, not a source of wealth. The trap gets worse when lifestyle inflation kicks in. Get a raise? Buy a nicer car, maybe a bigger apartment. Before you know it, your expenses have risen to match your income. This is why high earners often struggle with finances. They might earn more, but they spend more too. This is why doctors, lawyers, and even some CEOs sometimes find themselves with little to save or invest. To escape the salary trap, start thinking of money as a seed. A seed that, when invested, can grow into a tree that produces more seeds. If you keep planting those seeds, you'll eventually have a forest, a sustainable source of wealth that doesn't require endless labor. Value investing is one way to plant those seeds and let them grow. Chapter 2. The Investor's Secret. How the wealthy break free. The wealthy don't just work for money, they make money work for them. And one of the best ways to do that? Value investing. This strategy, popularized by Benjamin Graham and later adopted by Warren Buffett, focuses on buying high-quality companies at prices below their intrinsic value. Value investing isn't about get-rich-quick schemes, it's about getting rich slowly and steadily. One key to this strategy is identifying undervalued stocks, companies that are priced lower than they're truly worth. Think of it like shopping for luxury brands at a discount. The potential for growth is there, but the price is temporarily down. According to data from Morningstar, over a 10-year period, undervalued stocks tend to outperform the market by an average of 2% to 4%. Value investing works best with a long-term approach. A study from Dalbar Inc. found that the average investor only holds onto a stock for about 3 years. But research from BlackRock shows that investors who hold stocks for over a decade have a significantly higher chance of seeing positive returns. Patience is a cornerstone of the wealthy's investment strategy. They know that time, not timing, is the biggest factor in growing wealth. How do you start? First, research companies with strong fundamentals, solid earnings, low debt, and a good reputation. Sites like Morningstar or Yahoo Finance can help you find companies with strong track records and sound financials. Next, look for companies in industries that are likely to grow, even in tough economic times. For example, healthcare, tech, and consumer staples are sectors that historically tend to be resilient. The wealthy think differently about money because they see it as a tool for building more wealth. If you want to start on the same path, begin by setting aside a portion of your salary specifically for investing. Even $100 a month can add up significantly over time. According to a study from Vanguard, investing just $100 monthly in an account with a 6% average annual return can grow to over $15,000 in 10 years. The secret isn't huge sums of money, it's consistency and patience. Chapter 3. Time is money. Literally, how compounding turns pennies into fortunes. Compounding is the magical process of earning returns on your returns. Albert Einstein reportedly called compounding the eighth wonder of the world. Here's how it works. When you invest, you earn interest. That interest gets added to your initial investment, and you start earning interest on the combined amount. Over time, this effect snowballs, and your money starts to grow faster and faster. Imagine you invest $1,000 at a 7% annual return. After the first year, you'll have $1,070. But next year, you're earning 7% on $1,070, not just your original $1,000. By year 10, your money will have grown to almost double, reaching about $1,967. Leave it for 30 years, and that original $1,000 would grow to $7,612. It's not magic, it's math. But it feels magical because the growth becomes exponential over time. Starting early is critical. If you start investing in your 20s, even small contributions can grow into a significant sum by retirement. For example, if a 25-year-old invests $200 per month in an account with a 7% return, they'll have around $500,000 by age 65. But if they wait until 35 to start, they'd only have about $240,000. The difference? 10 years of missed compounding. One way to maximize compounding is to reinvest dividends. Many companies pay dividends, regular payments to shareholders out of their profits. By reinvesting these payments, you increase the number of shares you own, which boosts the amount you earn over time. According to Fidelity, reinvesting dividends can increase your total returns by 2% to 3% annually, making a big difference over decades. Another tip: automate your investments. Set up automatic transfers from your bank account to an investment account each month. By automating your investments, you make it a habit. You'll be less tempted to skip a month or spend the money elsewhere. In the long run, this small habit can lead to big results. In the end, compounding is a tool anyone can use to build wealth. It doesn't require a high salary or a special skill set. All it takes is consistency, patience, and time. Remember, the wealthiest investors didn't get rich overnight, they let compounding do the work. And you can, too, if you start today. Chapter 4. Cheap stocks, big gains. The art of spotting undervalued gold. Buying undervalued stocks is like finding hidden gems at a garage sale. Value investing is about finding solid companies whose stocks are selling for less than they're truly worth. But how do you know what's truly worth it? Start by looking at a company's intrinsic value. This is the actual value of a business based on its assets, earnings, and growth potential, not just the stock price. A company's stock price can drop for many reasons that have nothing to do with its real value. Sometimes, market fear or temporary news makes prices fall. For example, during market downturns, stocks like Coca-Cola and Microsoft have traded at discounts, even though they were fundamentally strong. When others were selling, smart investors saw these as opportunities. One way to find undervalued stocks is by using the price-to-earnings (P/E) ratio. The P/E ratio measures a company's current share price relative to its per-share earnings. A lower P/E ratio often signals an undervalued stock. According to analysts, a P/E below 15 can indicate a good deal, but it also depends on the industry. Compare it to competitors to see if a stock is cheap. Another key metric is the price-to-book (P/B) ratio. This ratio looks at a company's price relative to its book value, essentially, what its assets are worth. If a stock's P/B ratio is below 1, the company might be trading for less than the value of its assets. Investors like Warren Buffett have used this to their advantage by finding companies selling for less than they're worth on paper. Take Bank of America, which Buffett bought in 2011 when it was trading far below its book value. This was a calculated move based on real value, not just the stock price. Today, that investment has brought in billions. For Buffett, it was about patience and seeing value where others didn't. Chapter 5. Risky Business. Why playing it safe is dangerous for your wealth. If you think playing it safe means avoiding risk, think again. When it comes to building wealth, avoiding all risk can be the riskiest move of all. The reason? Inflation. When inflation rises, the purchasing power of your money decreases. Even if inflation is just 3% per year, that means your money loses value over time if it's not invested wisely. Let's look at cash savings. The average savings account in the US offers around 0.05% interest, according to Bankrate. Meanwhile, inflation has averaged around 2–3% annually. This means that by keeping your money in a savings account, you're actually losing purchasing power every year. Over decades, this loss can seriously impact your wealth. Investing may seem risky, but in the long run, it's a far better bet than leaving cash idle. Stocks, for instance, have historically returned about 10% annually, according to data from Ibbotson Associates. Even with ups and downs, that's a solid gain over time. Long-term investors can ride out market dips and still come out ahead. Diversification is another strategy to balance risk. Diversifying means spreading your investments across different types of assets, like stocks, bonds, and real estate. This way, if one asset class falls, others might balance out the loss. A study by Vanguard shows that a diversified portfolio has historically reduced risk by about 20% compared to a single stock investment. If you're just starting, consider investing in index funds. Index funds track the overall market and are less risky than individual stocks. According to Morningstar, index funds have outperformed 85% of actively managed funds over the last decade. They also have lower fees, which means more money stays in your pocket. Another strategy is to keep a margin of safety. This is an idea from value investing legend Benjamin Graham. He said, "The essence of investment management is the management of risks, not the management of returns." Buying stocks with a margin of safety means getting them at a price that is lower than their intrinsic value, providing a cushion if things go south. If you enjoyed this content, make sure to subscribe for more tips on building wealth and achieving financial freedom. Your journey to becoming a savvy investor starts now.